Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Diving right back in again, right? So free markets work. That was where we left off. So if you believe, in fact, that whether you believe that free markets don't work or that free markets do, it's important to identify that. Now, there are people in both camps, all right? It's kind of like the active versus indexing type of debate. But some people or others, in fact, most of us, have never really thought about it, right? Do they work? Do they not work? And what does that have to do with my investing? But as an investor, in fact, it is tremendously important for you to define your belief structure. Most investors have never had the opportunity that I'm sharing with you today, an ability to kind of identify that for yourself. All right. Instead of just using the latest hot investment strategy or something, that may have been recommended to you by your uncle or a neighbor or, a friend. What we want, in fact, is to define what you believe, and that's going to help you then in investing and also peace of mind in investing as well. So, beliefs dictate action. So if you believe that free markets work, you're going to behave differently than if free markets fail. So let's look at that next slide. All right, so there are two completely different ways of looking at the world. In the age of many shades of gray, please excuse that pun, right? This is a black and white decision. All right, attempting to believe a little bit of both and taking action based on contradictory beliefs will prove disappointing. So this is, now the thinking here with Mattson is that you can't have it both ways. That in fact there are, you either choose to be in free markets work and free markets, or that free markets fail. You're going to pursue an active strategy, or you're going to pursue an indexing strategy. Now, since this time, there have been new indexing strategies that have come to bear as well. Some of those that will help you control your volatility even further. Now, usually when you're controlling, the more you manage risk, you are going to sacrifice potentially some return. The asset allocation models we're going to be talking about, however, have shown over the last 20 years that this can be a real benefit to you and that you're not necessarily going to sacrifice return in the process. So the first principle of that of market efficiency, and then another is that diversification. All right, so if you look at the second principle, developed using the concepts of Markowitz, Sharpe, and Miller, modern portfolio theory examines portfolio performance based on risk and return. So as I mentioned earlier, Dr. Harry Markowitz won a Nobel Prize in 1990. He is the pioneer when it comes to modern portfolio theory. Wrote his doctoral thesis back in 1952. Again, won the Nobel Prize in 1990 for the work in the field of investing, he and Merton Miller. It took nearly 40 years for computer technology to advance to the point where his theories could be proven. Much like Albert Einstein, who wrote the black hole theory on the back of an envelope, even though the first black hole was not actually discovered in space until 40 years later by the Hubble telescope, Mr. Markowitz, like Einstein, was truly ahead of his time. And let's look at the next, which is the Markowitz efficient frontier. And this graph is showing basically on your left the annualized compound return going up the left in those numbers, and then along the bottom, standard deviation. So when it comes to managing risk, one of the things we talk about is what does that really mean? And how do you even measure risk in a portfolio? Well, academics use something called standard deviation. This mathematical formula basically allows us to statistically look at risk, and we refer to this as standard deviation. And the higher that number, the higher the standard deviation number, the higher the risk or volatility in a portfolio. So when we look at the market over the last 50 years, we see an average return of about 10%. Then when we compare that, okay, measuring the market, meaning the S&P 500 index. Now, if we look at a moderate portfolio over the last 20 years and even over the last 50, we see that it actually gives us about the same return, but with about half the risk or volatility. And that's what we're seeking to do with modern portfolio theory, okay? So let's look at the next one, which is determinants of portfolio performance. I've said to you many times, right? The biggest determinant of what type of return you're going to get on your portfolio, on your investments, is asset allocation. Okay, this is the biggest determinant of return as well as of risk. Now, how can we manage this? How does asset allocation work then to manage risk? And we talk about asset class correlation here. Correlation is the cornerstone of diversification and may help you potentially achieve higher returns with less volatility. So correlation, basically, an example that I like to use, let's look at that next slide, is what we'll see is you can see that two investments, let's say you have airline stocks and oil company stocks. So when oil prices are really low, that benefits the airline stock, right? They're able to buy their fuel cheaper. That helps make them more profitable. So their stock would be higher, where the oil company would be lower. Now, what would happen when oil prices go up? Now, the oil company's stock goes up in value, and the airline's profitability goes down, which negatively affects them. So since we don't know what's going to be happening at a given time, we just own both. If I own both oil companies and airline, right, when one's up, the other's down, and they smooth out that volatility for me. That's an example of asset class correlation. Now, let's look at what that looks like in the portfolio design. And that's how to actually use this correlation. So the potential to increase returns and reduce volatility. I'm going to use a simple example here that, again, this comes from Matson Money. This is a great program they put together to show you how these things work when it comes to indexing, when it comes to investing. All right, so let's go to, this is the slide, potential to increase returns and reduce volatility would be the heading, and it'd be the one before this one. All right, now in this one, how to lower it is how to blend together the S&P, how to blend together different asset categories. So I think I'm missing that one. So what I'll do is on that three-factor model, we'll show you how that works more in detail. But basically, as I blend together, let's say the S&P 500 index, and then I'm going to put in some international as an example. So even though international have been down over the last 10 years, okay, it would have a negative effect. If we look over the last 20 years, we see where internationals could have added a lot of value in a portfolio. So how to use these can help you and blend them together, and in what formula can help you manage your risk in a portfolio while getting the desired rate of return. All right, so let's look at the three-factor model. So that's this one. This is, and how these are used. One is called the market factor. And again, this was developed by Dr. Eugene Fama and Kenneth French. And this principle basically shows how the three-factor model is basically going to explain 97% of the variability of returns. So the market factor is one, the size factor is another, and the value factor the third. So that makes up the three-factor model. Nobel Prize winning research showing us, and that they did to show how to put together a portfolio, but at the same time, there have been additional factors added since then, and I'm going to share that with you as well. But on the three-factor model, let's delve into that, sharing the first factor being the market factor. So here we see when we compare, for instance, the S&P 500 index, right, the 500 largest companies in the United States, those stocks, with that of T-bills, Treasury bills. This is going to be the safe fixed part. And what we see is from 1926 through 2018 that the average return was just under 10% for stocks. But look at that standard deviation, almost 20%. That's a lot of volatility. However, when we compare with T-bills, on the other hand, very low volatility, very low standard deviation, but of course the return at 3.34. What do we typically see? We're blending together fixed and equities. But for return purposes, what we see is that the stocks are more risky, and therefore the potential return is much greater as well. The size factor is the second factor. So factor number two on the size factor, now we're comparing the S&P 500 with small companies. All right, so we go with the 500 largest companies to the Center for Research and Stock Pricing's U.S. Small Company Index. And what we see there now is that small companies, as you can see, outperform large companies over that same period. But now look at that standard deviation. about 50% more volatility with those small companies. Now, one way you can see that, if you watch the financial news at times, and you'll see them scroll across the Dow Jones Industrial Average, the S&P 500 Index, NASDAQ, and of course the Russell 2000. And the Russell 2000 is the 2,000 largest of the small companies, and you'll see that it doesn't always move. So yesterday the market was down a bit on the large caps, and yet the Russell was up. The same thing, you'll see variances where the market might be up 1.5 and the Russell's up 3, and vice versa. You can have negatives there as well. So more volatile, but bigger return over time. Now, what is the third factor? It's called the value factor. So the value factor, now we're comparing companies that have either a high book to market, value stocks, or low. And another way to look at it is value companies are companies that are typically selling below their market value, and it's usually because of some distress. So they may have lost some market share to a competitor. They may have a shakeup in management and it's created some problems for them. Whatever it may be, okay, they're selling below their book value. The potential then is that they can grow much greater, and the returns are going to be higher over time. Of course, you're going to have, compared to the S&P 500, you're going to have also higher standard deviation or risk. So what we're seeing basically is that by these three factors, it's defining what we're going to see with regard to the return and risk. The more return we're seeking over time, typically the more risk we need to take on. Now, we're going to show how blending those together, however, how putting these principles together can not only give us the return we're seeking, but actually reduce volatility or risk. But first, a break. Join me here. We'll be right back on the Retirement Report.